Hello there, Prof. Aram here, and in this video we're going to discuss the valuation of common stocks and how can we approach the valuation of common stocks. So let's get to this. Similar to the bond valuation, all we're doing here is we are going to identify the cash flows first. So when you look at your asset, which is the common stock, what are the cash flows that you may receive from this asset? And then you simply find the present value of the future cash flows. That would be your price or the value of the company for today. So what are these cash flows when it comes to common stocks? You can receive cash in two ways when you buy a share of a company. One is through dividends. The other one is when you sell your share to the company or to another investor. As with bonds, the stock price is the present value of these expected cash flows. So dividends that you receive are considered the income component of the return. We're going to talk about dividend yield in future videos. And then when you sell your share, you're going to realize capital gains or losses. So there's either an income component or a capital gain or loss component when it comes to cash flows that you may receive from a common stock. Let's look at an example here. We are assuming that we have only one period in our investment. Suppose you are thinking of purchasing the stock of Moore Oil Inc. and you expected to pay a $2 dividend in 1 year, and you believe you can sell the stock in year one for $14. If your required rate of return on investment of this risk is 20%, what is the maximum you're willing to pay for this? The maximum that you want to pay for this should be the present value of the cash flows, the two cash flows that you will receive. So your timeline will look like this: $2 dividends plus $14 proceeds from the selling of the stock, you will have $16. So in year one, you will receive $16. So your N would be 1 because you receive it in year one. Your discount rate is 20, future value is 16. You find the present value or the price of this stock to be $13.33. Now, let's extend this to another period. In two periods, right, you receive $2 in year one, and then you expect to receive $2.10 in year two, plus you can sell the shares for $14.70, right? You have 1680. So in this case, what's the price? Same as before. You do the present value of the first cash flow discounted at your required rate of return, and then present value of the cash flow in year two discounted again at the required rate of return raised to the power of 2, you'll receive this. So you can see the pattern here. The 3 period, all you're doing is to find the present value of cash flow in year one, cash flow in year two, which are dividends in year 1 and 2, and then cash flow in year 3, which is the dividend in year 3, plus the proceeds of the selling of the stock in year 3, and then this. So a pattern emerges. You could continue to push back the year in which you can sell the stock, and you would find that the stock price is just the present value of all the expected future dividends. So the price of the stock is nothing but the present value of the future cash flows that the company would receive. Of course, there are some companies that are not paying dividends currently, but there is an expectation that the company is going to pay dividend at some point in the future. Usually, when the companies progress in their life cycle, when they reach to the mature or declining phase, of their life, they need to start paying back the cash flows to the shareholders of the company because they don't have enough growth opportunities to invest that cash in. So they need to return the cash to the shareholders. But if the company is young and they still have a lot of growth opportunities, they're going to reinvest that cash and keep it in the firm rather than paying the dividend. So the point here is that even if the company doesn't pay dividend right now, they may do it in the future. The hope of that dividend that you're going to receive in the future can allow you to price that company. But if there is a company that pays zero dividends and they basically announce that we're never going to pay dividend in the future, then it's not rational to hold that stock because the valuation comes from the cash flows that you will receive from the share of that company. So we are going to look at 3 special cases of dividend payments. One of them is when the company pays dividend, but the dividend is not growing. So it's a constant dividend, or when the growth rate is 0. So this is going to be an example of a preferred stock. And the way we compute it is using the perpetuity formula. The other one is, let's say the dividends are growing at a constant rate forever. The firm will increase the dividend by a constant percent every period forever. So for this one, we're going to use the growing perpetuity model. If you remember, the growing perpetuity formula was like this. And then the last one is the supernormal growth, in which the dividend growth is not consistent initially, meaning that you might have 10, 20, 15% in the beginning, but eventually the assumption is that eventually you're going to end up with a constant growth, like a second case. Eventually you're going to end up with a constant growth, right? And then you can use the constant growth model or dividend growth model to value that stock. So for this third case, the price is computed using a multi-stage model. We're going to do this pricing in several steps. I hope you find this video useful, and thanks for watching.